Welcome back to Investing Talk Podcast.
Today we're looking at Bitmine Immersion Technologies.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Bitmine. The reason this company has landed on our desk isn't because of some small incremental improvement.
No, not at all.
It's because of what really looks like a genuine, dramatic earnings inflection. I mean, we're seeing a complete overhaul of their financial profile here.
Okay, let's unpack that shift right away. Because the numbers we're looking at for fiscal year 2025 are, well, they're staggering.
They are.
Especially when you compare it to their previous low revenue phase. It feels less like growth and more like a seismic shift into real profitability.
That's exactly the right way to frame it. When we look at the full year net income, the figures, they suggest a massive transition. You actually have two different numbers to look at, which depends on the accounting standard being used.
Okay, walk us through that, because one figure is $328.1 million and the other is $89 million. That's a huge gap.
It is.
Which one tells the real story?
Well, both are critical, and it really highlights the complexity of companies that hold, massive crypto assets on their books. The higher figure, the $328 million, that often reflects GAAP generally accepted accounting principles.
So that can include mark-to-market gains on their digital assets.
Exactly. Which means if the value of Ethereum shot up during the year, that paper gain has to be reflected as income, even if they haven't sold a thing.
Right.
So that $328 million figure, it really demonstrates the total economic benefit when you factor in that massive treasury they hold.
Okay, so then the $89 million figure, what's that?
The $89 million is often what they report using a more, let's say, conservative operational accounting method. It basically strips out those volatile non-cash crypto gains.
So the $89 million is maybe a better indicator of how efficiently they're running the core business.
The actual mining and infrastructure operation, yes.
Count it.
But even $89 million is a huge jump into profitability. And when you look at their core revenue, it completely validates that operational shift.
What are those numbers?
Revenue climbed 62% year over year, hitting $510 million.
Wow. And
what's really fascinating is that their fully diluted earnings per share, using that comprehensive GAAP number, it reached $13.39. That's why institutional investors are suddenly paying attention.
That kind of profitability is only sustainable if they have superior operating leverage, right? I mean, costs can't be scaling as fast as revenue.
You're exactly right. And the margin confirms it. Their net margin expanded sharply to 17.5%. For a sector that is, traditionally very capital intensive, that figure is just superior.
And it tells you they have a structural cost advantage.
It does. It tells you they can capture revenue way more efficiently than many of their air-cooled competitors.
Okay, so explosive top line and margin expansion is great. But my next question is always about stability. Is this all built on, massive risky debt, or is the foundation solid? What's the balance sheet look like?
The balance sheet is remarkably conservative. As of the end of the last reported quarter, they had $87 million in cash and equivalents.
And
versus low total debt of only $22 million. They are not heavily leveraged to fund this growth at all.
Low debt is great for security, but what about liquidity? In a volatile sector like this, cash is king.
Liquidity is excellent. We look at a metric called the current ratio. That's their current assets divided by current liabilities. Their ratio is 3.4.
And for anyone who doesn't track that daily,
just know that anything comfortably above 1.5 is considered robust. So 3.4 signals serious resilience. It means they can cover their short-term obligations 3.5 times over. They have a massive cushion.
That conservative foundation is key. But for me, the most convincing signal, the purely operational one, wasn't just in the margins. It was in customer behavior. I'm talking about the customer advances.
Yes. The prepaid revenue for their mining as a service platform, MAS. That is a huge bullish flag.
It really is. These advances, this is money customers pay up front for future mining capacity. They increased by 156%.
Wow.
To over $1.8 million. I mean, think about that. Customers are willing to prepay for services from this company. That tells you demand is surging.
And that trust is high. It shows their operational momentum is very, very real.
It also gives management a huge advantage, doesn't it?
A huge one. That prepaid capital funds their expansion without immediately forcing them to, issue new stock and dilute shareholders. It's a very healthy, organic way to fuel growth.
All right, let's transition now from the financials to the actual strategy that's generating all this.
Yeah.
It's clear Bitmine is not just some standard commodity miner. They have two very distinct structural competitive advantages. Moats, really.
They do.
Let's start with the one that's driving those operating margins. The proprietary tech.
The first moat is their proprietary immersion cooling systems. This is the core reason for that 17.5% margin we talked about. If you picture a typical data center, it's just noisy, it's hot.
And using tons of energy on air conditioning.
Huge amounts of energy. Just to keep the machines from melting down, Bitmine does something completely different.
So what's their approach?
They submerge their servers, all their hardware, in these baths of non-conductive dielectric fluid. Think of it as a mineral oil that's specifically engineered for this.
Immersion cooling.
That's it. This fluid pulls heat away from the hardware far more efficiently than air ever could.
It sounds exotic, sure, but what's the real-world financial benefit here?
In this business, it's staggering. These systems reduce data center operating costs by over 40% compared to traditional air-cooled competitors.
40%.
And that huge reduction translates directly into a 15 to 25% cost advantage per unit of computing power they sell.
A 40% reduction in OpEx is not a marginal gain. I mean, that is a complete game changer when energy is the single biggest input cost.
Exactly. And that is why their customer retention rate is above 92%. Once clients are using this super efficient infrastructure, the switching cost of going back to air cooling is just too high.
It effectively locks them in.
It locks them in.
So they are selling the most efficient pickaxe out there. But here's where the story gets really interesting, because they aren't just focused on technology.
No, they're also focused on asset accumulation.
Right. And that brings us to their second, very unique competitive advantage, the massive crypto treasury strategy.
This strategy positions them uniquely in the entire sector. Bitmine is now positioned as the single largest corporate Ethereum treasury holder globally. This moves them beyond just an infrastructure provider.
It makes them a major strategic asset player.
It does.
Can you put that into perspective for us? How much Ethereum are we actually talking about here?
They hold over 2.83 million ETH tokens. And that's not a small number. It represents about 2.9% of the total ETH supply currently in circulation.
And the total value.
When you combine those digital assets with their cash, their total holdings were recently valued at an eye-watering $13.4 billion.
That completely changes the risk-reward profile of the stock. They get compared to being the MicroStrategy for Ethereum, focusing on asset appreciation along with their profits.
That's the common comparison.
But let me push back on that for a second. Isn't this strategy inherently risky? Doesn't turning an infrastructure business into a leveraged asset holder just expose investors to extreme, unnecessary volatility?
And that is the core question you have to ask yourself as an investor here. Management defends this by arguing they aren't just acquiring assets randomly. They view Ethereum as a core, programmable, future institutional asset.
So they believe its value appreciation will far outstrip the volatility risk.
Right. They are making an explicit, long-term strategic bet on Ethereum's institutional validation.
And they've stated a very ambitious target for that, haven't they?
They have. Their internal goal is to acquire 5% of the total ETH supply over time. If they achieve that, they're making a statement that they want to be, inextricably linked to the underlying digital infrastructure itself.
Okay, so we've got explosive financials, the tech moat, and this massive aggressive treasury strategy. Let's shift gears and talk about strategic corporate actions. These often signal management is preparing for something big.
And we've definitely seen those preparatory signals. Institutional capital is clearly flowing in. Fund disclosures show an 11% quarter-over-quarter increase in institutional buying recently. And management completed registered direct offerings specifically aimed at institutional investors just last fall. So sophisticated money is actively taking positions.
And when the big money starts flowing in, management usually cleans up the corporate structure, right, to get ready for the big leagues? What have they done?
There are two major technical signals. First, they executed a 1-for-20 reverse stock split back in May of 2025.
Which is typically used to boost the share price to meet listing requirements for a major exchange.
Exactly. And the second signal, the filing that gives them flexibility.
The S3 shelf registration.
That's the one. Think of the S3 shelf as a strategic toolkit. It lets management quickly raise up to $500 million or use their stock for mergers and acquisitions without going through another lengthy SEC filing process.
So when you put the reverse split and the S3 shelf together, what does that signal to someone holding the stock today?
It signals that management is systematically preparing the company for a major corporate event, most likely an uplisting to a major exchange like the NYSE or Nasdaq.
And beyond just uplisting.
Beyond that, these actions position them for potential index inclusion. Think the S&P Small Cap 600 or the Russell 2000. Index inclusion is huge because it forces passive funds and ETFs to buy the stock just to track the index.
That provides a really compelling long-term thesis. But let's focus on the immediate future. What catalysts can investors look for in the next, say, 3 months?
There are several immediate drivers. The Q4 2025 earnings report is scheduled for January 2026, and that should reflect continued momentum. Then, management is set to launch 2 new product offerings in their immersion cooling portfolio by the end of this year.
So strengthening that tech mode even further.
Exactly. And then there are those fascinating whispers about external validation for their tech.
Right, the semiconductor collaboration rumors.
Yes. They're still unconfirmed, but there are ongoing rumors of a potential collaboration with a Tier 1 semiconductor manufacturer. If that happens, it would be massive. It implies a major chip maker sees value in Bitmine's cooling IP for things like high-performance computing or even AI data centers.
That would validate their technology far beyond just the crypto mining space.
Absolutely.
Okay, we've painted a highly bullish, multifaceted picture here. Tech dominance, financial stability, a huge asset base, and corporate maneuvering. So, as responsible analysts, we have to dedicate equal time to the bear case.
Of course.
What are the key risks that could derail this whole trajectory?
The primary risk, and we really can't overstate this, is the extreme volatility of the underlying crypto assets.
It's inherent to their dual business model.
Completely. Remember that $13.4 billion treasury value. A major downward swing in the price of Ethereum or Bitcoin directly impacts the company's balance sheet and that high net income figure.
So you're absolutely betting on the stability of the crypto market when you invest here.
Without a doubt, that's the macro risk.
Are there company-specific risks we should be mindful of?
Yes. Customer concentration is a major one. The latest filings show that their top 5 clients account for 37% of their total revenue.
That's a big number.
It is. While their retention rate is high, losing even 1 or 2 of those major clients would create immediate and significant turbulence.
And that operational risk leads us right back to valuation. With all this excitement priced in, are we dealing with a potentially overvalued asset?
That's the balancing act. The whole sector's valuation is elevated right now, and Bitmine is no exception. Metrics like price to earnings and price to book are substantially higher than peer averages.
Suggesting the market has already priced in a lot of this future growth.
It does. If they miss targets or if the crypto market just stagnates, that valuation could be very hard to sustain. And of course, you can't ignore the general regulatory climate.
All right, the regulatory uncertainty is always there.
Exactly. Especially around corporate crypto holdings and, crucially, energy consumption. However, Bitmine's tech moat, that super efficient immersion cooling, does offer a partial defense against energy crackdowns, since they're part of the solution.
So after analyzing the explosive growth, the 2 moats, the catalysts, and the risks, what's the final thesis for the listener? It really seems like this stock has a dual appeal.
It does. Bitmine Immersion Technologies combines truly compelling technology-driven growth. That 40% cost reduction is just hard to ignore, with the structural upside of that massive strategic asset treasury. It appeals to traders looking to capture upcoming catalysts.
But it also offers something for long-term investors.
Right. It offers long-term investors that structural upside, provided they are comfortable with the inherent volatility of that Ethereum bet. It is a high-conviction, high-volatility play.
It's that unique combination, isn't it? The proprietary energy efficiency and that ambitious push for 5% ETH ownership. They are betting heavily, not just on their cooling tech, but on the future institutional validation of Ethereum itself.
That's the core bet.
And the final thought you should be mulling over is, what would the valuation look like if that thesis fully plays out and they actually hit that 5% target?
If you enjoyed this analysis, make sure you subscribe to the podcast so you don't miss our next look into the market.